Hello and welcome to The End of the Chain. I'm your host, Samuel McCullum. In this episode, I'm joined by Jesse Proudman, who is the CEO of Strix Leviathan, an algorithmic crypto-focused quantitative hedge fund. Jesse comes on to talk about a bunch of stuff, from navigating the OTC markets to understanding Tether to just really riffing on what it means to be in crypto today. So I hope you enjoyed this episode, and make sure to subscribe to this podcast and also to our mailing list to get all of the updates right to your email whenever we publish. All right, so that wraps everything up. Let's jump into the podcast. Jesse, welcome to The End of the Chain.
Thrilled to be here. Thanks for having us.
I know that you had started a company called Blue Blocks, and then they were acquired by IBM back in 2015. And you kind of bounced around between different divisions once they determined that you can figure out what you want to do with IBM. And you came to the VC side of things and their accelerator, specifically at IBM. But one of the things that IBM has done in terms of blockchain since 2016, 17, is develop Hyperledger, which is a private blockchain developed for small, medium enterprises. I've never really been a huge proponent of private blockchains. I want to start in kind of getting your feeling on, since it's been 3 years almost since you left, what have you seen at IBM really since then? And how do you think that the Hyperledger system can develop, or is it even necessary in today's network systems that are being built out?
Yeah, it's a great question. So IBM acquired Blue Box in June of 2015. I spent the first year and a half after the acquisition working with the IBM Cloud Group to integrate the broader Blue Box product into IBM Cloud's private cloud initiatives, and then began to look for other opportunities there. And the blockchain space and the blockchain initiative at IBM in particular were really interesting to me. From my side, like, I'm most interested in blockchain due to the financial aspects of it. The sort of blockchain as a distributed database is not super interesting to me. So when I was making that transition, my pitch was to effectively become the subject matter expert on the cryptocurrency component of blockchain. And at that point in time, IBM didn't have a focus or an interest on that side. They wanted to stay out of sort of the cryptocurrency component. They wanted to focus on more the supply chain style implementations. And so that original sort of pitch that I made was denied. I was offered a role as a product manager working on the Hyperledger project. And I think my challenge or concern is very much like yours. Like, I think particularly in 2017, so this was all happening sort of in the midst of the summer of 2017, the word blockchain or distributed ledger was being used really as a marketing initiative to be able to gain sort of excitement from folks without really thinking through the rationale for why to use these sets of technologies. And I think by far and large, it doesn't make sense to add the complexity and overhead that private blockchains create for the use cases that they're being used for or were being used for at the time. I think there can be certain use cases where this technology does make sense in a private sense, but for the most part, when you have a bunch of parties that trust each other, which most of the implementations that were being done at the time were for, you don't need this kind of overhead. So that role wasn't particularly interesting to me. I ended up settling on the accelerator role, trying to develop a blockchain-focused accelerator for startups, and wrote the prospectus for that. And then ultimately, my job was to continue to research the space over the summer of 2017. And then at the conclusion of 17, IBM came back and it was determined that there wasn't capital to fund the accelerator. And so I made the decision to leave and to launch Strix. Mm-hmm. Kind of over the last couple of years, I've been watching the IBM blockchain group sort of from my periphery. I think that organization is led by one of IBM's better managers, Marie Weeks. She ran IBM Cloud when we were there for a period of time, so I interacted with her. under that domain. And she seemed to be sort of in IBM, there's two casts of characters. There's like the lifelong IBM folks that have kind of moved from role to role to role and have kind of worked their way up in the company. And in my eyes, IBM has this culture where you don't really fail out of IBM. You kind of fail up to some extent. And so a lot of folks were in positions where they, in my eyes, didn't necessarily have the technical or leadership capability to effectively run that organization. And then there were other folks in the organization that really seemed to get it. Like they understood what the technology landscape IBM was operating in looked like. They understood what it took to lead. Marie was one of those leaders. So I felt like at least that organization had a good head on its shoulders, and it seemed to be pulling many of the brighter folks from the IBM organization into it. I just think that the issue, and this is kind of IBM's broader issue, has been this focus on revenue, like immediate revenue growth over investing in research and development. And in any emerging technology, blockchain in particular, there's going to be a pretty significant lag between capital you invest now to understand and develop sort of a new domain and the revenue that's going to materialize from that investment down the path. And IBM, particularly under the leadership of Ginni Rometty, was so focused on quarterly revenue growth that there wasn't a lot of tolerance or patience for sort of longer term investment. And that's the concern I had at the time, and the concern I've kind of continued to have over the last couple of years. Like, there's not significant being measured in hundreds of millions or billions of dollars investment from third-party companies into private blockchain space yet. Like there's investment, there's interest, but this is not the next Watson at this point in time, and it's going to take time for that to materialize. And so the question I have is there patience or the ability to sort of wait out that time frame? And I'm not sure kind of how that's played out internally, but that's been my observation and my consideration.
I think you called IBM a marketing machine primarily in one of your previous interviews, and they have to keep rolling out technologies to sell to their clients to drive revenues, like you said. I think it doesn't meet the necessity of why you would ever need a blockchain. So I'm in the camp of probably 99% of people don't need a blockchain, or companies. It just doesn't do anything for them. And you're right. It adds complexity onto the typical business operations that they would do and makes it more difficult for them to grow as a company. If you do move on to using a blockchain, like going halfway just doesn't do it. You kind of have to jump all the way in to using Ethereum or something else, which would then allow you to develop specifically for the traits that are inherent to those blockchains itself. So we're like, I work for a company that issues securities. We're actually, I think, the only company that has a tradable security token on Ethereum right now. And it's really hard. Like the amount of legal that goes into every decision that we make, which is the majority of the problems that we have. And I can see this just exponentially magnified for a company like IBM or any other major corporation, which does not want to get in the sights of the SEC or any other regulatory body when they're trying to roll out this new technology to their clients, because it's the last thing that they would want to end up on was some like huge liabilities from breaking securities regulations. But there's only a few benefits that are really specific, and if you don't offer those benefits, then there's almost no point. But if you can figure them out, which I think we have, then there is a benefit to using a public blockchain. But I don't know about a private one.
Yeah, I think you're exactly right. And you think about, in my eyes, like some of the most applicable use cases outside of financial transactions, like the one that always comes to mind for me is property titles, property deeds. And so here is a existing legacy process that involves a bunch of physical paperwork. It's shuffled around from signing partner to the escrow agents to the being recorded and with each individual city. Like, it's just an old bureaucratic broken process, and it's expensive and it's painful. That is a use case where you've got a bunch of parties that don't necessarily trust each other, where you want a history that is immutable. It's like a perfect use case. But then you think through the regulatory landscape of what it would take to change how that process work, and it's just immense. And so the challenge I think that IBM has, or that anybody sort of going down that private blockchain road has, is that most of the use cases that really do make sense, and where a private blockchain or even a public blockchain would be applicable, are touched by so many historical actors and would require so much agreement across so many different parties to make that transition. Like, the bureaucratic headwinds themselves feel almost impossible to overcome. And so that's the challenge. And so you end up with sort of these pilot projects that are amongst small groups of trusted parties to try to sort of prove that the technology works. And it just doesn't, the benefits, I don't think, outweigh the effort.
Yeah, exactly. I'm excited to see what comes out of IBM, because I know there's a lot of smart people working there, especially on Hyperledger, and it adds back into the system of all the other different networks of what they're developing, right? It's a win-win for everybody else. But at the same time, I don't see how it directly affects their business bottom line, their business revenues in the short term. I mean, maybe the long term they can figure it out, but who knows?
The powerful piece is that IBM truly is a marketing machine. Like, I've always been impressed with their marketing organization. And for the broader blockchain industry as a whole, IBM has the ability to inform and educate such a broader audience with the marketing budget that they have than any of us, any individual company could do kind of on their own. And like, that's a really powerful benefit to having IBM in this industry, right? I remember sort of the end of 17, beginning of 18, you would see these IBM ads in the airport talking about blockchain technology, and at least it starts a question for folks. Like, the answer may not be particularly clear, but if IBM can just get people interested in the space and can get people starting to do their own research and learning more about what's involved here, like, that's a net win. Whether or not you're exactly right, whether or not that has a financial benefit for the company as a whole it's a different question. But from a industry promotion perspective, I think they've done a great service.
I'm of the opinion that even in 2020, even with the release of CME futures and the development of, Grayscale, Trust, and all the different products that have been released in the past couple of years, I still see these platforms, these networks, as retail predominantly driven networks, right? Where the individual users that make up of it are the ones who are driving price, and who, may not have that level of sophistication, which would be equivalent to a Goldman or a top level, like a top tier hedge fund that's managing, hundreds of billions of dollars, right? Where they have specific outcomes which they want to affect onto the market by entering it, right? So I think we're inching closer towards that. I think there's a lot of issues in getting these types of entities on board. Just there's regulatory and custodial and all these things which are being solved at the moment. But when you look at the actual users of the products themselves, right? Once you get away from Bitcoin and you look at, like Ethereum or something else, primary users of these applications are retail clients. Even if they have $50 million, you could still probably consider them a retail user, just in the way that they're using it and the way that they are structuring their trade setups. So if that's the case, then if you're designing new products, right? So like at Realty, right, we've designed a product which is geared towards the retail client. We have, and the reason we do this, right, is because I see that public blockchains really solve three or four things. The first one is that they, of course, transparency and accounting. So if you issue a token or anything on a blockchain, you can see it everywhere. It's completely public and completely transparent. The second thing, which I think a lot of people miss, which is something that I kind of feel is really important. And we just haven't had the explosive growth of any use case for it yet, is the micropayments aspect of these public blockchains, and especially ones that are, when they shift to proof of stake and they can drive transaction costs down to a millionth of a cent or something. You had, what was the name of Google's the micro work site that they had?
I can't recall. That's how popular it was.
No, but do you remember what I'm talking about? It was something Turk.
Oh, Mechanical Turk?
Yeah, Mechanical Turk,
right?
On
Amazon.
Yeah,
Amazon has Mechanical Turk, yeah.
Right, exactly. So they shut Mechanical Turk down, I think, because the issue was that they couldn't make payments to people globally. And so, when people are making like a cent or 2 cents a day, that's not something that you can easily distribute. But on on Ethereum, you can send a tenth or a thousandth of a cent to someone if there's low gas fees for relatively low cost. And these costs should go down in the future. So I think the micropayments aspect gets really overlooked. Also, the interaction with DeFi, which we're seeing recently, has been huge. We're still kind of in the test phase of this like $1 billion rollout of DeFi products, and there's been a lot of I guess hacks and money lost. But somebody has to do it first. And then the fourth thing, which I kind of has been my thesis for all of this since the very beginning, is that cryptocurrencies represent like gap finance. So the reason that they were created, Bitcoin was created in the first place, was an alternative to the dollar. And every single major product which has seen growth on the crypto ecosystem has been a decentralized, either private or semi-private version of the dollar system. So Tether is a prime example, right? So why is there such demand for Tether? It's because it's a privatized or semi-privatized Eurodollar system, and people are hungry for dollars right now. So, if you can focus on those four things, then I think you can make it work. But if you're not focusing on those things, I think you're just gonna, you're just doing. It's an exercise in futility.
All right, I think it's spot on, and the sort of the broader cryptocurrency industry has been claiming that the institutional capital is coming for as long as I can remember. And the reality is, and we learned this the hard way at Strix, that the regulatory landscape is so unfriendly for institutional players to enter this space, whether it's to start new companies dealing with the previous items you've discussed, micropayments or new cryptocurrency networks themselves, or any of the DeFi pieces, or even just entities like ourselves that are trying to launch a fund. Like, the regulatory framework is not designed and is not friendly for the types of custodians you need to use in the space, the way the exchanges are set up. It's just it's a challenge. And so that largely keeps the institutional players out, which leaves, like you're saying, it leaves the retail users to be the predominant majority of capital flowing through this space. It's kind of an interesting result of traditional regulation and how that impacts this space.
Yeah. My belief was always that the crypto space exists because there's a gap which traditional finance can't fill. So if a Venezuelan wants to buy dollars in large amounts, they're heavily restricted. And then there's also OFAC sanctions that restrict their country even further from dealing with the U.S. banking system. Same thing if you're living in Argentina or somewhere where your currency relative to the dollar has been declining at an ever-growing rate. So I don't see the efficacy of these like a dollar-based DeFi system competing against countries that are primarily using the dollar, like the United States, right? There's really no point to move into a DeFi system away from traditional finance because there's such good structures already made. But
right, our systems work. Right?
Exactly.
It's like you go to Thanksgiving, you talk about what you do for work, and people are like, well, why do we need that? Why do I need some system to send digital dollars when I can just Venmo or PayPal capital here around? It's because we have, in the United States, we have these systems and they work and they're easy and they're plugged into everything that we do. we have the benefit and the luxury of that privilege. You think about countries that don't, or that have capital controls or any of these considerations, like there's definitely a need. And I think you're spot on. That's been fueling much of the growth in those products.
Mm-hmm. So if you look at like a product like DAI, which is it's a synthetic dollar that's generated from Ethereum basic attention token and some USDC. The reason that it's so important is that most people have found out by now that actually doing payments with Bitcoin or Ethereum or really any cryptocurrency is difficult and probably really hard, because it can change a couple of percent in an hour. Six block confirmation times mean that you could lose a percent or two on the phone call that you're doing with the OTC desk to actually trade the fund somewhere. But if you have a more stable asset, that's something that you can actually use for cross-border flows of money. And it provides a much better way of actually being a medium of exchange, and people would use that on a day-to-day basis. I love Bitcoin. I love Ethereum. I love it all, right? Because it's an alternative. But at the same time, I think there's an inherent volatility which doesn't ever leave any of it or all of these cryptocurrencies, right? And this, I think, is where you stepped in with Strix to take advantage of these huge volatility swings that are seen in crypto on a day-to-day basis.
Yeah, so spot on. So back half of 2017, while I was working on this accelerator initiative, my job was effectively to research the space, and started to look at enough of these trading charts and do enough analysis across a number of projects to realize at the end of the day, almost everything in cryptocurrency, like, it lacks shared fundamental valuation models. So if you go to the stock market or you go to the bond market, there are market participants with established valuation models that can generally agree on the value that something should be worth. And somebody's going to think it's worth more or less. But broadly speaking, there are models that market participants can use to come up with some thesis for why an asset should be priced the way it's priced. Like, that doesn't exist in cryptocurrency. There are some fundamental models based on transaction volumes or address counts, but they're not widely shared amongst market participants. And so as a result of that, effectively price is driven entirely by behavior, by speculation. And you combine that with sort of this fractured 24/7 liquidity pool. So you've got exchanges all over the globe that are trading these assets, and trading never stops. You've got all of these derivative platforms that create sort of immense leverage and pressures as a function of that. And then the last piece that was really interesting to me was market data. So I can't go to the New York Stock Exchange as a startup and get access to their entire trade ticker, like every trade that's being made on the exchange. But every crypto exchange allows you to subscribe to every trade that's being made on those exchanges. And so being able to aggregate that data in real time and make decisions on it felt like a really unique aspect to this space. So you take all of those things, and then you recognize that for the most part, in the top 10 coins, there is liquidity to be able to trade in and out. And it felt like the perfect recipe to go and be able to build software that would allow an entity to go algorithmically trade in this space. And early on, sort of as I was doing this research, I was sort of dabbling in the day trading space and began to realize, like, I was not very good at it, quite frankly. Like, there's a lot of emotion and fear and sort of human psyche involved in day trading. And if I was struggling with that, I realized so many other market participants weren't. And felt like if I could remove myself from the equation and be reliant solely on algorithms and on computers to drive the decisions, that would help. Often in crypto, people kind of make this recommendation to just dollar cost average into a position and hold it for a long time. And I think it's a good strategy for many people, but it's also also an emotionally difficult strategy in an industry where drawdowns can exceed sort of 80%. Right? It's very hard to watch. There's just always this trading quote, right? Like, it's more painful to lose money than to gain money. So it's really painful to watch 80% of your capital disappear. And I didn't want to do that anymore. So bringing all of those pieces together, it felt like an opportunity to build software to solve this problem. And that was the thesis to launch Strix in January of 2018.
So how has liquidity developed since then?
Yeah, I've learned so much over the last 2.5 years, and I went into this industry pretty naive about what was available and how everything would work. So when we started this company and when trading first started, everything was in theory and in code designed to go execute on an exchange. And you think about sort of traditional stocks, like if I want to go buy shares of Tesla, I don't really have to worry about liquidity. Like there is, you can move capital in and out of these large cap stocks sort of at will without having to think about execution cost. The moment we started and the moment we tried to begin to move any kind of capital through these exchanges, it was very apparent that on exchange liquidity was not where it needed to be to make any kind of these strategies profitable. And
well, just to jump in, so I think the main reason is that there's probably one or two exchanges which have most of the liquidity, and these are probably the most used ones that gets most of the volume, and then all the other sub exchanges are building out market making bots that are just arbing the spreads between the big exchanges and then their own.
Yep. Yeah, but even the big exchanges, right? Like we did this analysis the other day, and so we're now 2.5 years later. We did this analysis the other day to answer a question for a prospect. Like there is on Coinbase, if you are to buy, say, $1 million of Bitcoin, the complete execution costs, including fees and the slippage you'll get in the order book, it's significant. It's on the order of 40, 50, 60 basis points.
Oh, wow.
Depending on what's going on in the book. And $1 million, like for a retail investor, that's a significant trade. But for an institutional investor, that's not that large. And so this was the challenge then, and this kind of continues to be the challenge. So we quickly pivoted early on to work directly with OTC counterparties. And so an OTC counterparty is effectively, you could think of them as like a market maker. Well, they will block trade a preset price. So say we want to buy 100 Bitcoin, they will give us a preset price for that. That price will often be, or not often, will always be higher than sort of whatever the spot price is at the time. And then they will take on the risk to go find that Bitcoin in the market. And sort of the best OTC desks that we work with are often some of the best market makers in the space, and they have built the connectivity into broad swaths of exchanges so that they can go source that coin, or they'll have unique relationships with particular liquidity providers, so like miners, for example, in the course of Bitcoin, who are looking to offload that coin on kind of a regular predetermined schedule, and they'll have access to that. And so these OTC desks make their money based on the spread that they charge. From our perspective, that became more interesting because the execution costs became predictable, right? And when you're trading something that's algorithmically derived or that has been built using models, at the end of the day, you want to ensure that those execution costs can be at or below what you've modeled them in the models you developed. And that was our goal at OTC. So we started in 2018. We were working with about 4 or 5 different desks. And this was the first big wake-up call. In 2018, working with OTC desks meant you got on Skype and you sat in these Skype chat rooms. And when you needed to make a buy or a sell, you literally negotiated in a chat room with these 4 desks and figured out what the best price was, and everything was done over chat. It was incredibly inefficient. And it was my first sort of realization about how early this space truly was. Like the tooling was so premature and so just underdeveloped. That was a big shock. Over the next kind of year and a half, we started to see some advancements with a number of the counterparties we worked with. Many of these entities started to create their own APIs that we as a end user could use to sort of get our own streaming prices. And so now in 2020, we've built our own complete execution engine that instead of talking to individual exchanges, goes and talks to 6 or 7 of these OTC desks via their APIs and is able to kind of give us streaming prices. And it's transformed our business pretty immensely.
How much have spreads collapsed in the OTC market since 2018?
Yeah, it's obviously a function of market. it's a function of what's happening in the market, and it's a function of what coin you're trading. Bitcoin is obviously the most liquid of all of the assets that exist. And I would say spreads, when we started in 18, were in the 50 to 100 basis point range, depending on trade size and what was happening. Now we'll often see them in the 4 to 12 basis point range. So pretty dramatic compression. The interesting thing to me, though, is as you move down the list of assets from a market cap perspective, how dramatic the execution costs increase. So if you think sort of top 5 coins, so that's Bitcoin, Litecoin, Ethereum, XRP, Bitcoin Cash, like those all generally have pretty good liquidity. A number of those assets will at certain times be more expensive to trade. As soon as you get out from those top 5 and you go 5 to 10, the story changes pretty dramatically. And then below 10, it's shocking. So we've seen quotes for assets below the top 10 that are in the 300, 400, 500 basis point range. And These aren't large trade sizes. These are, you're looking at maybe $100,000 or $200,000 purchases of some of these assets. And it just gets ridiculous. And so it really, it's a testament to how much true liquidity actually exists in the space. Like you can go on CoinMarketCap and you can see these volumes presented that give it the impression that there's a lot of dollars sloshing back and forth in the space. But you quickly realize that so much of that is fabricated.
What about Tether?
Yeah, Tether's a tough one. So we have made a decision not to trade actively in Tether. I think Tether has done the industry a great service over the years. I think you're exactly right. I think it is used by an entire cohort of traders around the world who don't have access to traditional dollars. It's given them a medium to store capital that removes the volatility that exists in Bitcoin. So big benefits there. I think there's also this big issue I have around transparency, right? Like the entire premise of Tether is that there are US dollars backing the complete reserves of all of the Tethers issued on chain sitting in bank accounts. And
it's not true.
Well, it was the original premise.
Right, original premise, yeah.
And then we now know that that's not actually accurate, right? We know that there was a 25% deficit at one point in time. We know that they have, at other points in time, elected to use other assets to kind of back those reserves. Like that to me, and we know that was done without being particularly transparent until sort of the New York Attorney General case sort of forced them to update the website. Like that, in my eyes, if I am using something that is purported to be stable and supported to be stable because there are assets in reserves, like I want to know what those assets are, and I want to know that I can trust the issuer.
But like, here's the thing, right? Like my explanation of it to me, and this is what makes a lot more sense now, is that let's say I'm a Russian billionaire. I have a lot of money in Russia and maybe some offshore venues, but I don't have any money in the United States. And I want to get $50 million so that I can go maybe buy some Bitcoin, or maybe I can, pay my operations for my company, or, just do different things with it. Because of my status, because of who I am, and because I know the Tether people, I can just pick up the phone, call Tether, whoever it is, and say, hey, give me 50 million Tether, send it today. And they're like, sure, you're a billionaire. We know where to come and find you. Sign some documents just saying that you're good for it, and we'll send it to you today. And I'm pretty sure that's how the majority of all of this money, or at least all the Tether is created, right? So there is probably some dollars in an account somewhere, but I think the majority of it is loans that the company's issuing to very wealthy people so that they can go out and use it for whatever purpose they have. So they come to them and say, lend me Tether at whatever the going rate is, like 3 or 4%, right? I'll borrow this and then I will pay you back. And then they can go off, they can lose all their money in whatever kind of crypto they want. And then they come back and they have to pony up the 50 million plus interest once they're done.
Yeah, that's interesting. I haven't heard that theory before, but that would make a lot of sense, particularly if you look at the the piece that's always been confusing to me is to look at the issuance schedule. Like, if you go look at other traditional stable coins like USDC, for example, and you look at the way the market cap of USDC has grown, it is not in these giant lumpy blocks. And if you look at how Tether's market cap has grown, it's in $125 million chunks at a time, which doesn't make any sense. And one of the other big gripes that I have is that, particularly as a fund or as a market maker in the space, I can go mint and redeem USDC. I can go mint and redeem Paxos. Like, other stable coins have a process where I can take that coin and get true dollars back. Tether's process is not transparent. It's not easy. And there are very few people that I have met in this space who have actually successfully redeemed. Like, it is possible. I know people who have redeemed Tethers, but it is not a common practice. Like, that's a big concern. But I could see your theory there making sense in that world where you get these giant lumpy issuances on chain.
Yeah, because let's say I have a company, right? And I'm in China, right? And I need to send $50 million into India or Russia or somewhere. Normally, this would be a very difficult process. I'd have to go to my bank. The bank would have to approve the transfer. Then I'd have to send the money, and then the other bank would have to approve the transfer. This is going to take like a week or 2 weeks, and it's very slow. But by knowing the Tether guys, I can just make an OTC trade where I call them up and say, hey, I need $50 million today. I need it for my company. Here's how I'm good for it. Like, issue it to me now, and we can settle it later. And so they issue $50 million. I go on my way. I pay for all my operations. It's a stable coin, so there's instantaneous settlement when I pay with things. And so I can do all the business operations that I want to. And then at some later date, when I can, or maybe not even when I can, I just either sell this loan on to somebody else who then takes the Tether from me, or it just gets passed on, or I just keep the tab open while I use the money for different purposes.
Yeah, that makes sense. I think that the issue then is, if you and I are doing business together and I am receiving your Tethers, what do I do with them? Like, I can't get them back into dollars. The only really generally liquid market for Tether to US dollar is on Kraken, and the spreads there are pretty large, and there's not a ton of liquidity. So now I've got all these digital. I think you're
thinking about it in the wrong way. So I think if you take a look at it from an OTC perspective, it makes a lot more sense. So it doesn't have to be the exchange, like an exchange that you sign up for and try to find liquidity on there that you're trying to exchange your Tethers for. There's an article that was published by Cointelegraph, I think like 2 years ago in 2018 or something, but it detailed how these Chinese were bringing their goods into Russia and then selling them on the outskirts for rubles. So they would collect their rubles all day, and then at the end of the day, they would take all their cash to a trade desk, an OTC desk, where they would exchange their cash. Originally, it was for Bitcoin, right? When the price of Bitcoin was going up every single, like 10%, week on week on week, they were just buying Bitcoin and then using Bitcoin to pay off their debts back in China. But once the price started going the other way, then they switched to Tether, and Tether was the main way that they would transact cross-border and be able to, sell all their goods in different countries and then instantaneously be able to send all of those revenues back to China, to the company themselves.
Yeah, that makes sense. It's fascinating. We I've been looking at this world of sort of central bank digital currencies and thinking about the privacy implications of this. And so if you think about the model you just described, at the end of the day, since Tether rides on top of Bitcoin or Ethereum, or predominantly Ethereum now, all of those transactions are now publicly traceable. It sort of creates this surveillance effect. It's an interesting question around, like, how long can they continue to do that, knowing that they're sort of evading capital controls or evading sanctions, before governments sort of wise up and the chain analysis companies to get a bunch of these contracts to identify those capital flows.
Right, but I spoke with chief economist at Chainalysis, and he told me that what happens on chain is pretty much outside. I mean, they can't do anything, right? The only thing that they can control is when money comes into these exchanges or endpoints that they can control. So where you have an account that can be locked, and that's the only place that they can actually make a dent. But if you're doing OTC trades, if you send money and you're dealing with an OTC broker back in China or Russia or somewhere, I mean, that's fully on chain. You're exchanging cash or maybe cash or like a bank account. And you can do this all offshore as well, too. I mean, one of the things that happened, like I know this would happen a lot back in Russia many years ago. I think it's probably still exists, is that it's really difficult to move money offshore because of legislation that was put in place nearly a decade ago. So if you're a company, you used to be able to move like billions of rubles offshore in whatever manner that you wanted to. But they instituted this de-offshorization. Now it's extremely hard as a business to deal with, to do these sorts of schemes. And so the typical way that things were done would be that you would have a bank account or cash inside the country, and then someone else would have an offshore account where they would have, like money just in an offshore account. So you go to them, you say, okay, I'm going to give you my cash. I'll pay like 4% or 6% or something like that. And then, you give me your money offshore, and then you make the exchange, everybody's happy, and, life just goes on. So I think a lot of this happens, the Tether kind of made it a lot easier for these transactions to take place, because now the cost of moving into an offshore dollar and one that is essentially like having an offshore bank account is much easier, or maybe not easier, but it's another option for people who would like to, have a private offshore dollar that they can access.
And I believe an interesting component of that, if you look at USDC or Paxos, any of these other coins that are sort of onshore based, they all have mechanisms to sort of freeze funds. Mm-hmm. They had to build those in as a function of regulatory oversight. As far as I'm aware, Tether does not have that built into its ERC20 contract. Certainly, I don't think the Omni layer supports that. So that would explain, if this theory is correct, that would explain why there's such a significant volume there, and why the market cap of Tether can grow so much, or has been growing so much faster, particularly this year, than any of these traditional stable coins. It's a fascinating theory.
Exactly. So it's a privatized Eurodollar system, which was a direct response to the collapse, or at least the problems that existed with the Eurodollar back in 2008.
And so in this model that you're proposing, so my theory has always been that if it is truly backed by dollars, and those dollars are sitting in bank accounts, then as soon as the U.S. government or some other entity is tired of that tool or coin being used for whatever illicit purpose, or they just don't like it anymore, they go seize those dollars and away you go. But if your model, where these are actually fundamentally just backed by loans held with a bunch of different counterparties around the globe, like that's a much harder network of capital to go seize.
Right.
Which
exactly.
To some extent actually makes it a better coin. It makes it a better digital dollar than some of these traditional, like the USDC.
Exactly. So, the Eurodollar system, or traditional Eurodollar system, is based on a series of credit issued between banks, interbank lending, right? And so this is just Tether is just a privatized version of that.
This is what makes this industry so fun. Like it's incredible what private individuals have been able to build over the midst of the last decade.
Mm-hmm. I mean, again, so my fourth point, which I brought up earlier, is that all of these cryptocurrencies were created for gap finance, that there's a place where traditional financial systems cannot go because of regulatory reasons. There's huge demand for dollars, mainly, since it's the global reserve currency offshore. And the integration and creation of crypto into this new economy allows for all these new systems to be built, where people who weren't able to access dollars before now can get a digital dollar that is outside the purview or control of any regulatory body.
Yeah, it's interesting. Like you think about all of this was created because of Bitcoin, because there was an asset created that wanted to be sort of removed from the world of dollars, and now the end result is creating this mechanism that's just digitized dollars.
Exactly. And what's kind of the end goal that everybody's pushing for right now with DeFi is to be able to take your Bitcoin and create a credit-based synthetic dollar from it that can actually
Absolutely.
be used. Yeah.
Yeah.
Because I don't think anybody in the Bitcoin community expects that they will, maybe except for like diehard maximalists, think that at some point you'll be able to use your Bitcoin to pay for things. That's kind of died at this point.
Right.
Right. So the only other option that exists for the maximalists is price appreciation, or in this case, it's the ability to generate a synthetic dollar, or like a credit-based synthetic dollar.
Yep.
Yeah.
It's whether it's DeFi or centralized finance. You look at like the rise of BlockFi or the rise of Genesis Capital's lending book, and that is proof in point. Like Genesis issued something like $2 billion of loans in Q1 for exactly what you're talking about, that those holding Bitcoin and want to continue to hold Bitcoin for the long term, but also need access to use that capital to not have it just locked up on their balance sheet. They need options.
Exactly. And I think a lot of that is the mining community, which is strangely prescient of what's going to happen in maybe like the next week or two with the halving. So all the big difference between this halving and the last one is that there's a lot more. I'm pretty sure there's a lot more leveraged loans that are issued, and this leverage is created because I don't think the miners sell their Bitcoin. There's no, like, you don't mine Bitcoin to just sell it and collect a profit margin. Most of these people are speculating on the, like a 5x increase so they can dump their coins and make a bunch of money.
I mean, this has been such a fascinating topic for us and for the broader crypto community. And I think there's a gross misunderstanding of how the mining industry works. And you see all of these models that go back and they look at this data set of the two prior halvings and the price appreciation that occurred in both of following both of those. At the end of the day, the mining industry is so dramatically different today than it was in the last two prior halvings. Like, we have this industrialized process now where, the first halving, you sort of had recreational individual miners securing the network. The second halving certainly became a little bit more sophisticated, but the amount of capital that has gone into these industrialized scale mining operations now, it's so far above and beyond what I think people understand. And you're exactly right. Like, people say, oh, well, the block reward is being halved, and so the sell side pressure on coming into the space is going to be halved. But that's making the assumption that these miners take all the coin that gets emitted every day and they go immediately sell it to pay for their operations. And we don't think that's true at all. We very much agree with you that miners are in this space because it's a speculatory vehicle. They believe in price appreciation, and they're holding those assets and using leverage to go create the capital to pay their electricity bills, to buy new mining infrastructure, to do additional development and build out. And we saw sort of the first hints of that on our Black Thursday kind of in March, as miners were getting called left and right on their loans from a bunch of the lending desks. Fortunately, I think that was a great stress test for the lending desks, and all of the ones that we're aware of sort of passed it with flying colors, and that the sort of the system didn't collapse, that miners had some good control over their balance sheets and were able to kind of repay those loans. But this fallacy that all of the block reward is sold every day, I think couldn't be farther from the truth.
Right. I think at the majority of, you don't mine just to sell it off. You're hoping for a 2x or even a 10x, or in some cases like up to $1 million per Bitcoin price appreciation. And I'm pretty sure that every single miner that is running right now are speculators, and they're not just speculating with a bit of money. They're over leveraged, and there's even companies like BlockFi and maybe Genesis, which were taking collateral as the mining machines from the miners themselves to be able to issue more loans, which is incredible.
Yeah, we've done we work pretty closely with the BlockFi guys. I don't think that they have done that. I'm not sure about Genesis, but that would be a pretty fast, like, let's take an incredibly rapidly depreciating asset that has one use case as collateral as a risk officer. That would give me shivers down my spine.
I'm pretty sure I saw this somewhere.
I wouldn't doubt it happened. Like this, that feels like something that absolutely would happen in this space.
Yeah. But it really makes sense that you're a loan officer and you're trying to drive more loans from your business because things have been difficult over the past, couple of years, and you eventually find a large scale miner, maybe even one that has like 40 or 50 megawatts, and you start taking collateral from them as their equipment. But it's really you're playing with a nice edge right there.
It's a house of cards.
Exactly. So I have no opinions coming into the next 2 weeks. I mean, my kind of long-term thoughts on where Bitcoin is. I already think it's succeeded. I think that it does what it's designed to do already. And same thing for Ethereum as well too. And especially, Ethereum is just getting going with its DeFi systems. And so that's kind of the next step, is that, you have a layer one, or you have like a base token, right? But then everything on top of it, the integration of all these off-chain assets like securities, and then also like the digital dollars as well too. That's here now, or at least the securities are slowly coming, but they will. But that's a different story. But digital dollars are here, and then also base layer currency to secure the network is also here. Next is these just on-chain financial applications. Whether they're centralized or decentralized, it doesn't really matter. But the ability for people to do all the traditional leveraging and borrowing and lending that they normally would do with a bank. And that's really, I think, we saw that in 2018 with the growth of DeFi, right? And, the growth of the stablecoin industry. But again, it seems that it's built on another house of cards, right? Because I'm on like 99.9% that we're heading towards negative rates in the next, 5 years. Let's just say that, we've already seen some negative rates on the front end of the curve, but really it's like the 10-year and the 30-year I'm really, really it's one of the long-term bets that I have, is that rates go negative on the long end of the curve. And at that point, the stablecoin market really has a reckoning where, how do they make money by holding money? Because their business right now is just to collect billions of dollars and then make money on the carry. But how do they do that when you have a negative carry?
Yeah.
Yeah.
How do you penalize the users of the stablecoin appropriately if given that situation?
Exactly. What do you see for development of this stablecoin market?
Yeah, so in my eyes, we've had this really painful user experience problem that has existed in this space since inception. I had some belief that sort of 2017 would create enough of a focus on that user experience issue to kind of change it. And I've not necessarily seen that. Like, these are hard technologies to use. They're not user friendly. They're error prone, and the risk of loss is immense. Whether it's just Bitcoin or stable coins, like all of these technologies and coins and networks kind of suffer from the same challenge. And that continues to be a concern of mine. Like, widespread adoption, in my eyes, is not going to happen until we can solve a bunch of this user experience problem. And I don't know who's focusing on it, and I don't know how that ultimately gets fixed. So that's a concern. We've been at this for years, and still every time we send capital across one of these networks, there's sort of your heart skips a beat, making sure the address is correct and the funds are going to the right place. The stablecoin industry more broadly, I've been really impressed with the development of Paxos or USDC over the last couple of years. Like it's as someone who has to deal with both the traditional wire system and the stablecoin system, it's just such a better experience.
That's great. Yeah.
Being able to demonstrate sort of capital flows and being able to send transactions. He's like, everything about it is better than the traditional wire system. So we've kind of got something that's really interesting, but I absolutely agree. Sort of in this world of negative rates, like the sustainability, the long-term sustainability of these business models comes into question. I think there's solutions. I think there can be creative ways to somehow tap sort of the transaction flows of the network as a way to drive revenue. But I don't know what those look like. I'm glad that's not my business to solve. That's for sure.
I mean, one thing that you can do is that you can build in the negative rate into the token itself. So the token can lose value over time if you hold it just by them readjusting the supply every single day. So, if you had 1,000 USDC after a whole year of, let's say they have negative 2% rates, they could automatically adjust your coin balance down to 9,000, right? So 980 algorithmically.
Yeah, it'll make for an interesting world. Like you look at some of the business models. I mean, we referenced BlockFi earlier, right? They'll lend 8.6% on your USDC holdings because there's demand for them to be able to go out and lend that USDC to other folks. As that asset becomes potentially punitive to hold, it'll be interesting to see how those business models play out.
Yeah. So I found that article that I was talking about. So it just came out in the beginning of April. And so I sent it to you. It says, so Zach Prince said that we're starting to establish relationships with miners for the first time now. And then he says, 2 months ago, lots of lenders were accepting miner equipment as collateral, and this isn't happening anymore. Now the risk tolerance has declined. So it seems as if they, or maybe not them, but there was other lenders who was taking this mining equipment as collateral, and then the sell-off just completely probably like wrecked their balance sheets.
Yeah, that is a great article. That is exactly why anybody participating in DeFi or centralized finance in this space needs to do an immense amount of due diligence on the counterparty and what they do with their balance sheet and how they hold collateral. Like that's terrifying. And I'm glad it wasn't BlockFi. I'm glad it was the competitive landscape.
There's a lot more risk in investing in these companies. It's like it's startup investing, right? And there's been a whole host of companies which have come out of your area in Seattle, which really haven't succeeded. I mean, you had Dragon Chain, which came out of Seattle, right? And They lost 99% of their market cap. And I don't know if they're still working, but it seems that they're not where they were, and they haven't been able to grow where they wanted to grow. And I think there's been a lot of internal struggles there. But there's been a whole host of other companies like them, which have just come and gone and just have quickly faded into the token bubble that was. And you're really left with a few core providers that are just, I guess, dominating the space now. I mean, you look at USDC and its growth and Paxos. So, how do you take a look at these companies' balance sheets, and how do you take a look at the companies themselves to make sure if it's somebody that you'd want to work with?
Yeah, it's an interesting question. And I think 2017 created so many perverse incentives for market participants in the space because things were just so out of control that there's a lot of sort of consequences that we're still seeing from that today. It's interesting. Seattle actually has had far fewer companies emerge in the cryptocurrency space than I would have imagined when I started looking into this in 2017. Dragon Chain is still chugging along as far as I'm aware, but certainly they're not as successful as I think holders of the token would hope. There's Unicorn with Unicoin. You've got Stably here. Obviously, Bittrex, the exchange, is based in Washington. So we've got kind of a handful of companies, and there have been a couple others that have been acquired. Tenta Browser, and there was another one that was acquired by a healthcare company. But it's not in my eyes the community that I thought we would see, and that's interesting. As I looked at this space and as I've thought about it over the last couple of years, at the end of the day, this is all about liquid angel investing. Like you are making speculative bets into a handful of assets with the high probability that the majority of them are going to die, and your investment will go to zero. And to some extent, that requires that you think about it like a venture portfolio, that you need to spread your bets around as far and wide as you can. And that's always, this has been why, like, some of the maximalists that have belief in any single asset, it's always been confusing for me. Like, you wouldn't, in 2000, you would not make the argument that Yahoo was the only tech stock you should buy because Yahoo will win all tech stocks. You wouldn't say today that Amazon is the only cloud computing company that you should buy because they're going to win all of cloud computing. Like, it's a silly argument to me. And so to say that Bitcoin is the only thing that matters and the only thing that will survive, it doesn't feel appropriate given what we know about the space and given all the uncertainty in the industry going forward. So I think about it like liquid angel investing. I'm going to place a bunch of bets. I'm going to be smart about those bets. And so that's kind of step one. And then step two is really thinking about, like, what is the business model? What is the token appreciation model? Like, how am I going to get my money back from these assets? So in terms of the centralized finance lenders, if that means I'm personally lending capital to BlockFi, I want to make sure I understand what BlockFi's business model is, what they do with my capital, how they make their money. And I want to have a lot of confidence and faith in that business as much as I can. Same thing on the DeFi side. And I've personally made the decision not to participate in a bunch of the DeFi projects because I think we're in a big, it's a big state of experimentation right now. And you have to be willing to lose everything to participate in that. And I think I'm happy there are people that are right. Like, I think that's just, it's part of the evolution of the network.
Wait, does that include holding DAI as well too?
Yeah, I won't touch DAI. It's not that I don't think they're interesting projects. Like, I think it's a fascinating project. I think what they're trying to achieve is really interesting. But at the end of the day, I don't. And part of it is like being able to have a complete understanding, right? Like, I went to college with Eric Voorhees, who went on to found Shapeshift, and I went to Nick Carey, who went on to found Blockchain. Like, I've been friends with those guys for years, and I've been watching over their shoulders for years as they've built their businesses. I didn't have the intellectual bandwidth to understand Bitcoin until the beginning of 2017. Like, and I'm not super comfortable investing in things that I don't understand. So I missed out early on, but I'm okay with that because I want to make sure that I understand the ramifications of what I'm participating in. Like, being able to spend that time and that energy to understand the nuances and the mechanics and the whole situation with the ETH Oracle pricing, the auctions with DAI in March. Like, there are so many edge cases to all of these protocols that are going to be discovered over the next couple of years that I just don't have the bandwidth right now to try to understand and think through the ramifications of those.
I mean, potentially. I think that there's been a lot of good investigatory work done into what the different outcomes can be. I mean, I'm not sold on the eternal hopium that a lot of the maximalists have. I don't think that you would ever see a cryptocurrency like Bitcoin or anything else replace a fiat issued US dollar. And it's not even because the design of the cryptocurrency or anything is better. It's just that it removes the democratic process from the issuance of the currency itself. So we, I think, lose the fact that it was our own governments that created the Federal Reserve and also created the banking system, and it was legislated. So people may think that it was some grand conspiracy to establish some sort of strange control over people in the United States and to take away all their gold. But at the same time, we've created a really stable, dominant currency that has been able to become the global reserve currency of the world. When you take away these controls and you take away the ability for both lawmakers to influence and then also people to have a representative position in determining their money structure, I think it's a net negative. Even if the structure of the the crypto or whatever it may be, Bitcoin, it doesn't matter. Even if it's been hard coded in and nobody can change it, I think that having a voice and being able to, change monetary structure as you go forward is a really important factor in our economy and also our monetary and fiscal systems at large.
Yeah, absolutely.
Yeah.
I think all of these technologies, they're incredible. They're fascinating. I mean, people are pushing the envelope in what was thought to be possible. You look at even some of the DeFi attacks that have happened over the last couple of months. Mm-hmm. When you actually analyze them and you think about how they occurred, like it's pretty amazing how interwoven and interlinked so many of these different contracts and protocols have become.
Yeah,
like it's really neat.
I mean, the flash loans, the BZX flash loans hack was like amazing.
Oh, absolutely. And the fact that you've got people out there that understand this well enough to pull something like that off, like it's a testament to both the complexity of what's being built and to the creativity of those out there.
Right.
I'm kind of evaluating it all.
Right. And also, I mean, the ability, so just for people listening, right? So with the BZX hack, Steiny came on the podcast a while back and talked about flash loans. And this was before the actual hack. And it wasn't even really a hack. It's an exploit, right? Because they were able to borrow, I think, 10,000 ETH for a block. And during that block, they executed a bunch of on-chain transactions, or it's just one transaction, right? But a bunch of
kind of chained together.
Yeah. A bunch of interactions between all these different contracts, and we're able to steal several. I think the first hack was a couple $1 million, and the second one was like $600,000 or $700,000.
Yeah, that sounds right.
Yeah. So but this was like a brand new offering from Aave, and within like a month, you had someone use it for a system breaking exploit with one of these DeFi projects.
Yeah, same thing with the DeForce attack over the last couple of weeks.
Yeah, exactly.
Yeah. It's just, it's amazing how fast these things move, and then how quickly sort of they can be tested and validated that things are secure.
Well, I mean, what would you want to see before interacting with any of these contracts?
Yeah, that's a really interesting question. And this is, again, it's like I haven't been able to put the intellectual throughput in to figure that out. I think that the challenge that I have is that because contracts are sort of they're world readable, it's like the worst thing about open source software, right? Open source software, everybody can read the code, which means anybody with time can go look for exploits, except now there is financial reward for individuals that have identified those exploits. Mm-hmm. So that's the ultimate challenge. It's like, how do you know that these contracts are secure, that they aren't going to suffer from some edge case scenario that's not thought about because some additional set of contracts was brought online down the road? I just haven't thought through the ramifications of that yet. And there are much smarter people with much more time that are spending their energy focusing there. But I do think, like, regardless of that, I think it's really neat. I think it's showing the power that these platforms like Ethereum have created. It's showing the power of being able to interweave all of these different applications together. That's an incredibly interesting demonstration of what the next decade of development on these platforms will look like.
Yeah, I'm interested personally just to see if there is any other competitor that can grow to the size of Ethereum, right? So you saw Tesla's launched. You just saw Keep Network. Near. Yeah, Near Protocol was just launched. Affinity's coming. Filecoin will come at some point. There's a bunch of other protocols, which Telegram eventually, once they kick all the US investors out. So there's all these other different protocols that are launching, but none of them, I mean, you have to start on the back foot and you have to spend billions of dollars to catch up to where Ethereum is, because they're just...
Well, this Ethereum version 1 to Ethereum version 2 transition will be a fascinating case study for protocols as they think through ways to upgrade sort of the base layer technology. And I think Bitcoin gets a lot of grief for being sort of slow in its innovation, but I think there's been a lot of benefit to that for the industry, right? It's a stable and it's been a consistent operating entity with incredible uptime and reliability. There's a lot of benefit to that. This ETH1 to ETH2 transition will be the first time a multi-billion-dollar protocol is undergoing such a major transformation. Sort of how that goes economically, how that goes technologically, I think will be fascinating and will set the direction, I think, for a lot of these projects going forward.
Will you take a step away from trading ETH during that period?
Well, we'll definitely look at it. We have a policy around assets like the Bitcoin Cash hard fork in November of 18. If we think there will be network instability, we will suspend active trading of an asset. A big part of our business requires being able to actively send these assets on chain. And if the chains are broken or if counterparties have suspended their activities, then it's not an appropriate asset for us. So yeah, we definitely do a bunch of diligence around what we're trading and what market events within that basket that we're trading may impact.
Now, are you also working with like any banks like Silvergate or anything?
Yeah, we work with multiple banks in the space. Silvergate has been our longest partner, and we're big fans of theirs.
Can you just walk me through their dollar transfer system that they have between the different exchanges?
Yeah, absolutely. So Silvergate has a network they call the Silvergate Exchange Network. And effectively, it is a internal bank-to-bank transfer mechanism that has an API. So think about your own bank. Like if you have a checking account and a savings account, you can go onto your online banking and you can move money from your checking account to your savings account any point in time, regardless of bank holiday, regardless of what needs to happen, because all that's happening on the bank side is they're just updating their internal ledger. So Silvergate Exchange Network is exactly like that. It creates a mechanism that allows an entity like us to transfer US dollars to enter any counterparty that's active on the system 24 hours a day. And then they've overlaid an API on top of that. So programmatically within our platform, we can initiate these Silvergate Exchange Network transfers. And then they also have webhooks. So when a transfer is completed, we can be notified that transfer is complete and we can take action. So that's how entities like Coinbase or Circle, when you're minting new US dollar coin, if you send it over the Silvergate Exchange Network, it shows up in their account with an identifier. They get a notification on their side that new capital has arrived and they're able to respond instantly. So it's really for folks that are moving capital around frequently in this space, it's been pretty much a game changer. You're not reliant on wire systems. You're not reliant on the traditional banking system operating with the speed in which it operates. You can move capital and in and out of counterparties in a matter of minutes.
And has it changed your business structure a lot?
We've been on Silvergate Exchange since we launched.
Oh.
There were counterparties that we started with that did not accept Silvergate or that were not on the Silvergate Exchange Network. So to some extent, we ended up choosing our counterparties based on who was a participant there. So that's the biggest change. And I think because they were sort of first with that system, they have gained critical mass. And so now everybody sort of has to be there to some extent. Other banks like Signature Bank, they have something called Signet that is similar, or Prime Trust has something called Prime X, which is similar. But because those offerings launched after Silvergate, they're good offerings, but they just don't have that critical mass that Silvergate has been able to establish. I
purchased some Silvergate stock at IPO, sold it a little while later, but I know it's come down a bit. I'll probably look at purchasing more at some point. I think they have a really, strong business model and a particularly good use case for what they're doing going into the future. I had not looked at Prime Trust or Signature Bank yet, so it's probably good to look at them. I mean, they're not going to have their public disclosures in their 10Ks that get published every quarter, but it's very cool to see that sort of counterparty transfer development happen within the space.
Oh, it's been a blessing. I mean, you think about 2017, 2018, there just weren't banks available for most of the companies in crypto. So to see an entity like Silvergate kind of make a bet on this industry and then kind of go full force after that bet has been absolutely wonderful to see. And we think the world of the leadership team over there, the product's been great. We have a lot of respect for that entity.
Wait, so what other parts of your business do you have nagging problems that you would need another service provider or to come in and be able to provide a counterparty solution or custodial solution? What's missing at the moment? What are the biggest gaps?
Yeah, I mean, the infrastructure continues to be very weak for crypto funds. And we ended up, as a result of that, building an entire operating end-to-end platform to solve most of those problems for ourselves. So things like portfolio management, order execution, reconciliation, settlement, LP accounting, all of these pieces, they kind of exist in piecemeal solutions, but there's not been a provider out there that's been able to aggregate all of those into one end-to-end offering. And that's something that we ended up building from the ground up. We've thought about possibly selling that as a standalone product. But at the end of the day, there's just not enough market participants out there with enough assets under management to make that an interesting standalone viable business. So that's all a big challenge. And the second big issue is regulatory compliance. It's very difficult in this space, particularly for an entity like ourselves, that we're trying to be sort of transparent and compliant. Like that's our mandate. We want to do this the right way. And it's very difficult in this space to even know what the right way is. We have spent 10 times more in legal costs to set up and operate our entity than if we had just launched a venture fund, right? Because a venture fund, everybody understands what the structure looks like and what the documents need to look like. But in this world, you're constantly interfacing with lawyers, trying to figure out as the world evolves, how to sort of stay compliant and be doing things correctly. And it's a waste of money because we're doing that. Other funds are doing that. All the centralized lending platforms doing that. The OTC counterparties are doing that. We're all spending money on probably the same set of lawyers trying to answer the same questions, just as a function of opaque regulatory environment. It's a shame. So one thing that would be nice is sort of a centralized regulatory agency that was able to answer a lot of these questions. And it's becoming better. It's definitely better than it was in 2018, but there's still a lot of challenge.
Is this a problem that's specific to operating within the United States, or would you be having these issues if you had set up offshore?
Yeah, I think it's both. I mean, we have some unique issues because we're in Washington State. So in Washington State, there is the Department of the DFI, the regulatory agency that oversees investor protection. And so even if we had set up our investment management company offshore, the DFI still has jurisdiction because we're physically here. So we're working very hard with the DFI to do this all correctly. So that's a challenge. If we had been offshore entirely, I think that may have made it an easier issue, but it's still there's still question. I mean, you look at Binance and its regulatory endeavors, it's not particularly clear how they're set up. Or you look at what BitMEX has been doing. But there's no simple answer to all of this, right? Everybody is kind of trying to write the book as they build their business, and that's just it's a waste of time. It's a waste of capital in my eyes. Everybody here, by far and large, I shouldn't say everybody, by far and large, most of the market participants in this space have the desire to do this correctly. There's not a clear, correct way to do most of this. So you have to figure it out as you go.
Yeah. I think you're probably right on the infrastructure and then also the liquidity aspects that kind of prevent a lot of other larger institutional clients from coming in as well too. I know that the recent events of last month, March? Was it already March when the dip occurred? Yeah. So Back in March, right, when we went to almost zero because of one exchange, that is a scary thought process, right? That one single derivative exchange could potentially drive the price of BTC to, double figures if they had been able to, if they didn't kill the exchange. They literally had to shut the exchange off to stop the price from falling, which,
I mean, it's pros and cons of this giant distributed liquidity pools, right? I talked about that at the beginning of one of the things that really was fascinating and curious to me about this space. But despite all of those different liquidity pools, sort of March 12th really called out the reality that there are subsets of those pools or subsets of those providers that really have oversized impact on everything that we all do.
Mm-hmm. I was always of the belief that the CME futures would somehow settle things down, but after the events of March, I'm really not even sure that they matter, right? That you just now have a few derivatives exchanges where the outsized leverage allows people to do, I guess, specific. It's not even an attack, right? It's more of just they're able to push price the way that they want to farther than they normally would on a traditional like stock exchange or anywhere else.
Right. And you hear a lot of calls for things like circuit breakers in the aftermath of that event. When you think about the reality of having all of these distributed exchanges, like circuit breakers arguably work to some extent because they're on a single exchange. You're able to stop those assets trading on that exchange. But when you have Bitcoin trading across hundreds of exchanges globally, like circuit breaking on one doesn't necessarily stop a cascading effect. March 12th, I think, was largely driven by liquidations being pushed on MEX. So being able to pause those for a moment of time, which is exactly what they did by turning the exchange off, obviously helped the situation pretty dramatically. But if that's sort of the solution going forward for this type of situation, I think is to be determined.
I mean, it may not even be the best solution, right? Because you could just move from one derivatives exchange to another.
Right.
And also, take advantage of the it's because there's no centralized liquidity pools. It means that the liquidity is fractured, and you're able to push price around in these either with spot or with the derivatives exchange a lot easier than you normally would be if there was some sort of central liquidity pool.
I mean, I think it's the broader interesting question to me is it fiscally responsible or appropriate for these exchanges to be offering 50 to 100x leverage for traders, and what ramification does that have on the industry more broadly going forward? Like, would it make more sense to have some of that reined in? But other people would argue that it's that kind of leverage that makes this industry so interesting. So
I would agree.
The powerful piece here is that nobody can set these rules.
Yeah, I would agree.
The entire industry.
I mean, look at the FX markets, right? I mean, that's the closest analog to what's going on in the crypto markets, right? And with FX, you can get up to what, like 1,000, 2,000% on your collateral.
Yeah.
Yeah. And it's not really a problem. But then again, the FX markets are like a $6 trillion a day market.
Right. There is liquidity.
Yeah. Well, in the BTC markets, I mean, like you said, if you have 5,000 BTC, you can move the price a lot.
Yep.
Yeah. And that's a small amount. I think that what did they say? The March 12th collapse was caused by someone who had like 100,000 BTC, I think it was, or maybe 80,000.
It sounds definitely like a number that could be used to move these markets around. And
they took it what, 80% down or 70% down in a couple of days. It's just ridiculous. I mean, I think it highlights the lack of liquidity, and for as many exchanges have come online, and for all the different products that you have across all the different markets, there still is not the liquidity there that would allow for this type of product to grow into a global instrument that people use with a high degree of trust.
Right.
Right. Yeah. So, but again, these are just my opinions.
Yeah, no, I mean, I think you're spot on. I mean, liquidity, it's an interesting question. Like there's always liquidity. It's how deep is it?
Yeah.
You're highlighting that exactly in the way that is materially important, that the liquidity that exists in these markets is predominantly provided by market makers in this space and not necessarily by sort of new market participants. And, you go back to this halving talk, like much of the industry believes the halving is going to have a significant impact on price. And the reality is that we need new market participants putting new capital to work in the space to have a significant impact on price, and whether or not the halving kind of helps create that as a function of sort of a narrative that people can believe in, I think is to be determined. But it's not sort of this magical event that changes the existing market dynamics and the existing existing participation by new capital.
The longer that I am in the industry, the more that I see that people don't really have a good understanding of how their economic and monetary system works, especially the monetary system when you're talking about different lending between banks and how the Eurodollar system works and how it applies to crypto, especially, is something that I think is really lacking. And that kind of gets lost when you have all these monetary actions by the Fed. People look at, their $6 trillion of increase in their balance sheet, and they just think that somehow is going to get directly transferred into BTC somehow. When really the Fed is using that balance sheet transfer to be able to affect the yield curve, they're not distributing money to people. They're just affecting the yield curve, and also lending to tier one banks as well, so that the tier one banks can go out and lend. But it's just mind-boggling to me about some of the endpoints that people come to.
Narratives are really powerful, particularly in an industry where everything is speculative. And if you can get kind of enough people bought into your narrative, that it can manifest itself into reality. That's the fascinating part for us, and kind of a big thesis in how we've approached these markets. That's
a really good thesis, actually. That if you think it'll happen, it'll happen.
Right. If enough people think it'll happen, it can happen. It's an interesting observation.
That's probably a great point to probably wrap up on. Is there anything else that we missed, or that you want to talk about Strix for a bit?
Sure. I mean, briefly go over it. So we're quantitative hedge fund, trades cryptocurrencies algorithmically. You can find more about us at strixfund.com. Our big belief is that there is a better way to invest in this space than buy and hold, and that kind of being the leading transparent, kind of compliant provider, approaching it that way has been an important differentiator for us. So we've recently launched an investor portal that allows our investors to gain access and visibility into performance and documents and market news. We think that sets us apart. We are a hedge fund, so applicable to qualified purchasers. So always happy to speak with qualified purchasers who would be interested in learning more.
Great. Well, cool, Jesse. That was cool, and I had a great time going all over everything that we did. It was really fun.
Appreciate it. This was great as well.